Hello and welcome to S&P Stock Analysis. I'm Noah Howard.
I'm Ethan Shan.
Let's get into it.
We found that the best methods were regression, neural nets, and naive Bayes. This is mostly because a lot of our data was numerical. It could be very easily set into factors that were kind of numerical. And so we found regression to be really, really good with 99.9% accuracy. It kind of fit that straight diagonal line that we kind of wanted. Neural nets were also really good because we had a whole bunch of categorical data that could influence it to, I guess, give us the right revenue growth, like whether or not a company goes up or down. Naive Bayes was very similar as well. Um, when we try to predict revenue growth, just based off like high, low, close, full time employees, information like that, we managed to get a very, very high accuracy value.
And now for our worst methods, we have KNN. KNN didn't really work. The values kind of clustered around the diagonal because we didn't have very good K values at all. For decision trees, it had decently high accuracy, but the decision trees were very small, so it didn't tell us very much, even though the accuracy was decently high. With Market Basket, it gave us correct information as well, but the information that it gave us didn't really wasn't really useful. We could have gleaned it ourselves because we could only determine the industry based on the sector, and I could have told you that just by looking at it. With K-means, we just didn't have enough objects to put into 11 clusters, so that just didn't work very well.
Yeah. So some changes we could have done just to see if it worked. Um, we saw other groups like properly pre-process data into like these correct buckets, so Market Basket would actually kind of do its thing. For KNN, different K values could have been good. With higher K values, we could have clusters more towards that diagonal, onto like on the cross table. Um, Lower K values could have done that as well. With decision trees, we had to get rid of a lot of data to because it wasn't working very well with the R decision tree like function. So if we preserve more of that categorical data, we might have gotten better results.
And now, what could we actually do with the results we got? So obviously, we can predict future stock prices given an open, high, lower, close, and multiple other factors. Um, and we can do this. Basically, a good model for that was regression. That was really high accuracy, and it was just predicting closing market prices every day. We can also predict which industries are on the rise given current market trends for that industry itself, but also we can predict if they're on the rise by comparing them to the industry giants. If we can look at their past and see what their trends were and see if they compare to the newer companies which are doing it, we can kind of see if they're going to be a big company in the future. We can also understand the general current conditions of the economy by finding trends. If the trend is that all stock prices, on average are going up for that year, obviously the economy is doing pretty well. And if they're going down rapidly, obviously the economy isn't doing very well. But that's all. Thank you guys for watching.